Mr. DIY Group Malaysia, which sells everything from screwdrivers to instant noodles, posted a new high in quarterly earnings in the first quarter of FY 2025. Net profit jumped 20.2% to 174.15 million ringgit, while revenue rose 10.5% to 1.26 billion ringgit. How is its full-year outlook looking? We asked the Edge writer Anis Hazim.
What driving the earning is a mix of factors. One is the early festive season. We have a Hari Raya and the Chinese New Year happen in the same quarter. So I also say that Mr. DIY is riding on the festive sale boost. And then the second was strengthening of the ringgit and better margins. Because of the stronger ringgit, it will help them in terms of margin, and as well as the store expansion. But here's the thing, while everything, the earnings looking solid, Mr. DIY same-store sales growth was just 0.6%. That was after 7 quarters of negative growth.
This indicates that Mr. DIY's profit growth has been mainly driven by opening new stores, as the existing stores don't see much growth in terms of sales. The retailer maintained its full-year target of 190 new outlets.
They opened about 36 new outlets in just 3 months of 2025, and that's bringing the outlet now to more than 1,400.
Going into the second quarter of FY 2025, Anis says the group's margin strength is expected to continue after improving by 2 percentage points to 47.8%. This as the ringgit continues to appreciate against the renminbi.
In fact, analysts think that Mr. DIY could benefit more if there's a trade tension between the US and China, and that will help them in the supply chain from the China products, and that will be good for their margins moving forward. If you are a shareholder, here's a more good news, because Mr. DIY paid 1.4 cent dividend in the first quarter. That was like 40% increase from the same quarter last year. And they already beat their payout guidance of 50 to 65%. The 1.4 cent dividend is about 70% of payout ratio, so well above their guidance.
Anis notes that Mr. DIY remains in a net cash position, with cash and bank balances at 191.33 million ringgit. The stock is also trading much lower than its peers, like 99 Speedmart Retail Holdings, 7-Eleven Malaysia Holdings and MyNews Holdings.
As for white nets, analysts do expect a dip in seasonal sales. So in the second quarter, it might be slower than what Mr. DIY achieved in the first quarter, because we don't have any celebration or like festive sale. But overall, analysts do expect that Mr. DIY can beat its earning in FY 2024, because they have a solid net cash position. They have a store pipeline in coming forward, and then the consumer spending should keep Mr. DIY in the solid position throughout the FY 2025.